So are we starting on the dot at 3 p.m. So 1 more minute. Yeah.
Okay, no problem.
Just to ask the IT team, are we doing like a group photo before we enter the panel session, or should we do that normally?
Maybe text the picture first. Maybe it's a good idea.
Yeah. So intro and then take picture and then we go ahead, right?
Yeah.
Okay, Father Good. Thank you. Oh, okay. So are we? Let me know when we're sort of on air. Just to double check again with the IT team, are we ready to start?
I think we're ready, Nikki, because the recording is started.
Okay, so so we're on online, right? Okay, so welcome everyone, and should I just allow maybe a couple of seconds for attendees to enter the Zoom room meeting? Yeah, have they all entered with us? Yeah. Okay, so
participants.
Yeah, have the participants entered the Zoom meeting? Just to double check. Yeah. Okay, maybe we should just start and a very warm welcome, everyone, honorable panelists, guest friends. Welcome. Good afternoon to Professor Dedi Priadi, Pak Basri, and Pak Teguh Dartanto joining us from Indonesia, and to everyone joining us from Indonesia. And a very good morning to Professor Ferrero joining us from Oxford. My name is Putunati. I'm delighted to welcome you all and to moderate this very fitting and much needed webinar on the impact of COVID-19 on the global economy. This webinar aims to explore and highlight how COVID-19 and the policies that have been implemented as an effort to curb its spread has affected our economy. It also will touch on how it has impacted poverty and well-being, and explore how nations may build back better in the midst of this pandemic. So before we start, may I please ask everyone if they are willing to put their videos on so we can all have a group photo. So for the IT team, could I request your help to let me know when you've done a picture and when we should do the next picture? So please take it away to the IT team.
Okay. Done. Thank you.
Thank you so much to the Econ faculty's amazing IT team. So again, before we start, just a little bit of housekeeping rules. So please may I request questions from participants to be directed to the chat box, and we will have a Q&A session when the panel sessions end, at the end of the panel session. And without further ado, we now open this webinar, and I'm honored to turn to Professor Dedi Priadi, Acting Dean of the Faculty of Economics and Business, University of Indonesia, to deliver the opening address. Professor Priadi, the floor is yours.
Okay, thank you very much, Mbak Putu. Bismillahirrahmanirrahim. Honorable guest, Professor Andrea Ferrero, Professor of Economics, the University of Oxford, Dr. Chatib Basri, Senior Lecturer, Faculty of Economic and Business, Universitas Indonesia, and former Minister of Finance, Dr. Teguh Dartanto, Head of the Poverty, Social Protection, and Development Economic Research Cluster at Faculty of Economic and Business, Universitas of Indonesia, senior research colleagues from the University of Indonesia and the University of Oxford, ladies and gentlemen, colleagues and friends. Assalamualaikum warahmatullahi wabarakatuh. Salam, Om Swastiastu, Namo Buddhaya, peaceful greeting to us all. Good afternoon to all distinguished speakers and participants here in Indonesia, and also good morning to Professor Ferrero and to all those participating from Oxford. I hope we are all blessed with health, and we start today webinar discussion. I'm honored to welcome you all to this event and to open our discussion of the global economy in the midst of COVID-19. The aim of this webinar is to bring together experts and scientists from Indonesia and Oxford to discuss how the pandemic has impacted the world, particularly how it has impacted Indonesia. We hope that through this discussion, we may discover innovative solutions to the challenges we are all facing today. Distinguished colleagues and participants, COVID-19 has deprived all aspects of society. It has contributed to the volatility and disruption of world economic, including our own, leading to significant decreases in economic growth, particularly when the pandemic first hit. In Indonesia, the unemployment rate has increased significantly. Preliminary poverty rate forecast also suggests a sharp and significant increase in our poverty rate. Urgent action needs to be taken to support government effort in mitigating the significant challenges. Innovative solutions are needed to shed light on how to come up with solutions as pandemic has impacted different areas of the economy. Crucial insights are needed on how traditional economic tools such as fiscal and monetary policy have been and may be used in the future to help mitigate the impact of the pandemic. Solutions to better policy are also needed to support Indonesia achieve a strong and equitable recovery from this pandemic. We hope that this discussion may offer us clarity of how the pandemic is unraveling, and importantly, also give us hope and optimism for the future. It is my pleasure to welcome our distinguished speakers and all participants to this very important webinar. I eagerly anticipate the discussion we will have today. Thank you very much. Assalamualaikum warahmatullahi wabarakatuh. May peace be with us all. Thank you.
Thank you so much, Professor Priadi, for that very clear and relevant message, particularly touching on the importance of knowledge sharing and working together to find solutions to the devastating effects of this pandemic. We are all in this together, and the best way to come up with ways to emerge strong is to share experiences, to share our knowledge with each other. Now we turn to the panel session. I am very privileged to be able to say this, but I have had the honor to be a student of all three of our panelists today. We start our highly anticipated discussion with Professor Andrea Ferrero. Just a little bit of an overview of his outstanding career. Professor Andrea Ferrero is Professor of Economics in the Department of Economics at the University of Oxford and is the Levine Fellow in Economics in our college at Trinity College, Oxford. Before joining Oxford, Andrea spent 7 years in the research department at the Federal Reserve Bank in New York City, first as an economist and then senior economist. Alongside his inspiring work at Oxford University, Andrea is also currently an academic consultant for the Bank of England. I remember sitting in awe at Trinity's senior common room, listening to Andrea share his experience of working at the Fed in the midst of the subprime mortgage crisis. I'm so grateful and glad that we have you with us today. Andrea, the floor is yours.
Thank you very much, Putu. Let me share my screen and put up my presentation. And meanwhile, I would like to thank you very much for inviting me to this panel to discuss the issues with the COVID crisis. And in particular, given my expertise and my prior experience, I will talk about monetary policy during the crisis and close then with a little bit of speculation about what may happen in the future, given the consequences of the crisis. And as you know, was just anticipated, obviously this is only just one angle of the massive efforts that government, central banks, and other institutions have done in response to the crisis. So it's going to be by no means exhaustive, but hopefully still give some insights of what has been done, what else could be done going forward, and what we are kind of living through. So let me start by setting a little bit the stage and just give you a sense of how bad the crisis has been. So this is a chart from the IMF that shows the growth projections in 2020, 2021, and 2022. And you see that the global economy has experienced a fall in GDP of slightly more than 3 percentage points, with advanced economies being hit a little bit more than emerging markets and developing economies. And one may argue, well, 3% is not so bad. But if you put this in historical context and go back to 2008 and the global financial crisis, actually, despite being called global financial crisis, the world economy GDP did not fall back then because some countries were not as badly affected by the financial crisis. So this is actually one example. It's been a little bit like, very, very global by the very nature of the crisis, in which GDP fell everywhere. If we look a little bit more at the distribution of the effects of the pandemic, we see that the euro area has been hit particularly hard with a fall in GDP of 6.5%. In terms of geographical area, only Latin America and the Caribbean had a larger fall. Developing and emerging Asia is the geographical area that suffered the least, but still, again, a significant fall. And I think we also want to keep in mind that we need to think about this decline in GDP relative to the normal. So, obviously countries that typically experience high growth rates, even a small fall in GDP is still, quite significant. So now, going back to the US in this case, the other observation that I think it's important to keep in mind is that when the pandemic started in 2020, real GDP had not gone back to the pre-financial crisis trend yet. So here in blue, you have real GDP for the US. In red, you have the trend since post-war, 1947. And you see that the financial crisis had kind of what it looks like, at least from the perspective of today, a permanent effect, and the pandemic added on top of that. So many people are concerned that we're living in a different world ever since 2008, and new tools and new approaches are needed. And so at the end of my presentation, I will come back to this point, at least as far as monetary policy is concerned, to think about what we might expect going forward. So going back to the COVID crisis, you know, a large global recession with advanced economies hit particularly hard. Very many interventions on the side of economic policy. Again, I will discuss the monetary side, but we've seen massive fiscal packages being deployed pretty much all over the world that have tried to mitigate the consequences of the emergency. Although some of the policies, some of the measures that have been taken that, you know, were absolutely necessary may actually have exacerbated the crisis. This is a delicate point. It's hard to say. I mean, many people say, well, you know, the lockdowns have contributed to make the crisis worse. You know, it's hard to know, as usual, the counterfactual, what would have happened without, you know, without these lockdowns. Presumably, the health impact would have been much worse, and so, you know, also the economic impact may have been worse. But we've certainly seen the effects of these lockdowns on the economy, and this has certainly contributed to you know, to the decline of GDP and increase in unemployment. You know, there have been many type of interventions, and here today I want to focus on monetary policy, which is kind of my area of expertise. And is also, I think, it lends itself nicely to a comparison with the financial crisis, which I mentioned before, which was kind of the quintessential crisis for many people in our generation. Okay, so what I'm going to do, I'm going to spend most of the time kind of reviewing the actions that have been taken by major central banks, and then sort of make the point of comparing these actions with what happened in response to the 2008 financial crisis, and then finally conclude by discussing briefly some recent changes to monetary policy frameworks, both in the US, you know, also minor change in the euro area, and sort of mention what, you know, we could expect. Okay, so I have a table here that sort of points out major central banks, Bank of England, the ECB, and the Fed, what they've done in response to the crisis. And so the first observation is that the Bank of England and the Fed cut their policy rate, their nominal interest rate, quite significantly, 65 basis points for the Bank of England, 100 basis points for the Fed. There was no change at the ECB, but notice that in parentheses here, I have the level at which, you know, the ECB started. The ECB already had negative rates, and so there was basically no room for the ECB to cut rates further, whereas both the Bank of England and the Fed effectively brought the policy rate down to the lower bound. The ECB and the Fed introduced some language in their communication that basically mentioned that this type of stimulus would last until health developments would not improve. The Bank of England decided not to introduce that kind of language, most likely because the prior experience during the financial crisis was not particularly successful in that respect, and so decided not to introduce forward guidance. All three central banks deployed large-scale asset purchase programs. There is a little bit of details in this table. I don't think it's really worth me going too much into it, but the basic point is that all three intervene and in financial market and purchase large amount of assets, and finally also provided so-called liquidity injections, so direct lending to banks, basically, in order to facilitate the funding of private sector activities in the midst of the crisis. And lastly, importantly, in a world that is really where the dollar plays, you know, a central role, the Bank of England and the ECB set up currency swaps lines with the Fed. So basically, both banks and as well as other major central banks decided to basically agree with the Fed to you know, obtain dollars in exchange for their own currency at a fixed exchange rate, as to facilitate you know, the working of the financial system. Now, an important I think an important discussion to have in order to appreciate this type of intervention is a discussion that kind of emerged early on during the crisis. And it's the question of whether this type of pandemic, this COVID shock, had looked more like a supply shock or a demand shock. So if you go back to your you know, basic introductory macro textbook, clearly there are different responses depending on what kind of shock an economy is facing for the central bank. And what was particularly interesting about the COVID shock is that it carried elements of both. It had supply features. You know, I think the most obvious one is that some sector completely shut down, and so you think about global value chains, you know, supply chains that you know, work both at the national and the international level. You know, those were clearly perhaps the first signs that the economy would be hardly hit by the COVID pandemic. But then domestically, especially, we've seen people losing their jobs, being on furlough, and so, you know, a lot of demand factors also play a big role. And I think that especially early on, today we're seeing slightly different dynamics, but especially early on, the demand factors seem to have prevailed. So, you know, it's always hard to come up with you know, a definitive answer just by looking at the data. But here, if you look at inflation, here there is a red dot that maybe it's a little bit small, should have been a little bit bigger, but I hope you can see. That's basically the level of inflation right when the pandemic started, and you see that after that inflation fell. So when we see both output and inflation falling, that's typically a sign that there is a big demand shock taking place. And so, you know, clearly the demand channels seem to have prevailed. And so in response to this type of dynamics, demand kind of shocks, the action the central banks have taken make a lot of sense, right? You try to provide monetary policy accommodation to facilitate this type of the economy, to kind of allow the economy to recover from this type of shocks. Now, so in this sense, the monetary policy response has been straightforward. You want to cut interest rate to basically restore output towards potential and bring inflation back to target. As I just showed, inflation was falling below 2%, which is the target for all three this central bank. And so, you know, the interest rate cut was the natural response. But as I showed you in the previous table, actually central banks did a lot more. And so the question is, why is that's the case? And here the answer is also pretty straightforward, and it's because right before the onset of the crisis, the nominal interest rate in all three areas was very close to its lower bound. So, you know, the country that had the highest interest rate was the US, that had just an interest rate of 1%. And so there was very little policy space for the Fed, and even less so for the Bank of England and the ECB to cut interest rate. And so basically, if you go back to Keynes, we were already close to the situation that he called a liquidity trap. So that's basically where we aware, which is also where these countries found themselves during the financial crisis of 2008. So what can you do when you are in that situation? Well, all three central banks went back to the toolkit that they developed during the financial crisis and deployed the so-called unconventional monetary policies, which broadly speaking take three forms. One is forward guidance, one is purchases of assets, and one is liquidity injections. And as I mentioned before, all three central banks use this alternative instruments. Just to explain briefly what they are. First of all, when you think about forward guidance, effectively you should think about the commitment by the central bank to keep interest rate low, not just at any point in time, but also in the future. So kind of a conditional promise that until things will not recover, the interest rate will remain low. And because the underlying theory is that expectation about future interest rate should affect today's decisions in terms of consumption by the private sector and investment by the business sector, then this commitment should actually provide stimulus to the economy. Now, this measure works through long-term interest rate, right? Because long-term interest rate should, on average, reflect expectation of future short-term interest rates. But it also really requires that central banks are credible. So that's really an important prerequisite on which I'll come back a little bit later. The second type of unconventional monetary policy that central banks have used is asset purchases, also known as quantitative easing, which essentially are purchases of long-term government bonds by central bank, not directly from the fiscal authority, but on secondary markets. Here, the idea relies on the very simple observation that asset prices are inversely related to yields and hence to market interest rates. And so if the central bank buys long-term assets, it bids up its prices and then and thus lower their yields. And so long-term interest rates should fall and stimulate economic activity. And finally, liquidity injection are a complement that is typically deployed in the most intense phases of the crisis. So we've seen these liquidity injections taking place immediately after the pandemic erupted, and are measures that basically imply that the central bank purchases private sector risky assets and takes away the risk from the financial sector, injecting safe assets. And the rationale here is that companies typically in crisis situations struggle to raise the funds that are necessary to continue their operation. And so the central bank acts as a lender of last resort in a situation where interest rate cuts are not working or are not available. And sometimes people make the comparison with bank runs. So basically there is a need for funds, but it's hard to raise these funds at a short notice. So the central bank intervention basically acts as a source. In a picture, I want to summarize basically this type of intervention by showing you how normally monetary policy works. So you can think of the central bank here on the top left of your screen affecting the nominal interest rate. Here is a chart taken from the Fed, so it refers to the federal funds rate, which is the policy rate for the Fed. And then through financial intermediation, these actions that the central bank takes affect all kinds of short-term interest rate on other financial instruments. And then through the term structure of interest rate, it affects long-term interest rates on government bonds, which in turn are the reference for mortgage rates, for consumer rates, for corporate rates, and so on. So this is the mechanism of transmission of monetary policy in normal times. Now, when you are in a crisis, some of these links are broken, and typically the link that goes from policy action to financial intermediation is impaired. So what this unconventional monetary policies do effectively is to bypass these links and act directly on long-term rates and hence directly affect economic activity. So now the natural question is, at least for people who have been studying this type of interventions like myself, is how does this compare with what we've seen in 2008? And as I already alluded to, the toolkit has been essentially very similar. The main difference really that we've seen is the sequencing and how fast central banks have deployed unconventional policies in this crisis compared to 2008. In 2008, possibly because some of these actions were unprecedented, what we've seen is interest rate cuts first, and then unconventional monetary policies only taking place later. Whereas liquidity injections took place in the most intense phase of the financial markets freeze. Think about bankruptcy, Lehman Brothers bankruptcy, and forward guidance and asset purchases really occurred only later when the macroeconomic effects of the financial crisis materialized. In 2020, we've really seen all these measures being deployed roughly at the same time. And again, I think the main reason for this is the initial level of the interest rate. So I think just to make this point, a picture says more than lots of words. Here you see the level of the nominal interest rate for the US right before the financial crisis. It was just above 5 percentage points. And you see that the Fed effectively brought down the interest rate all the way to zero. So this oval here measures the size of the stimulus. And so, it's basically 5 percentage points. Now you go back to February, March 2020, the level of the nominal interest rate was 1.25. And so the policy stimulus was about, a quarter of what we've seen in the financial crisis. So it's kind of obvious if you look at it from this perspective, I think that central banks, given the size and the scale of the crisis, had to do more than just cut interest rates all the way to zero, and they had to do it also. Now the next question is, this is actually a question that was there already pre-pandemic: is what's going to happen in the future? Are we going to be living in a world of low interest rate going forward? And I think from my perspective, the answer is, yeah, there's a good probability that's going to be the case. Now, what I mean by a world of low interest rate is I don't mean low nominal interest rates forever necessarily, but I mean low average real interest rates. And here I have a chart of real interest rates going back all the way to the mid-'80s. And you see that especially from the second half of the 90s, there's been this downward trend with real interest rate, excuse me, getting close to zero right after the financial crisis. And this, I think, what we should expect going forward. There are secular forces at play that are going to keep real interest rates low for the foreseeable future. And this is going to have an impact on central banks' decisions. Which leads me to the last couple of slides of my talk. What should we expect going forward? As I said, and show you with a couple of slides, we've seen interest rate being already low before the crisis erupted. And in fact, if we look at the UK and the European Monetary Union, rates were even lower. In part, it was a legacy of the slow recovery from the 2018 crisis. In part, it was a consequence of structural economic factors. Both the Fed and the ECB have responded to this, have recently reconsidered their their frameworks. And in particular for the Fed, we've seen a pretty significant change in their way of operating from inflation targeting to average inflation targeting. Now, it sounds like they only add average, so it's only a small change, but I think it's actually a pretty significant one. Because what average inflation targeting does is to compensate past misses on the inflation target with, especially if you think from, missing the inflation target from below, with future above target inflation. And why is this important? Because it crucially makes one aspect of unconventional monetary policy less unconventional. It makes it systematic because it's effectively embedding into the monetary policy framework what forward guidance was trying to do. It effectively embeds expectation of expansionary policy right when you need it in a crisis. Now, the caveat here is the same mechanism may work in reverse, which is that when there is a boom, the expectation will be of a prolonged tightening after a positive shock. But I think on balance, the Fed thought that the problem is really at the lower bound, and so it decided to go for this. Okay, so I'm running out of time, so I better conclude. We've seen a wide array of monetary policy measures and more generally economic policy measures in response to the COVID crisis in order to provide support for the economy and stimulate aggregate demand. This is kind of textbook response, similar toolkit as what we've seen during the 2008 financial crisis, but with a little bit less space for action, so that determined a different timing of intervention, more aggressive use of unconventional monetary policy earlier. Going forward, I think we should expect central banks to remain active and definitely more active than before the 2008 crisis. There are aspects that I've not discussed today related to financial stability, to inequality, in some countries even to climate change, that will keep central banks busy going forward. And it will definitely be interesting to see the response also to the current inflationary pressures and how it will change the behavior of central banks around the world. Thank you very much for your attention, and I'll be happy to answer any questions later on.
Thank you so much, Andrea, for that very insightful overview of how the pandemic has affected nations, how central banks have responded using their various monetary policy tools, and for your messages for the future. You have really illustrated how economic theory may help us disentangle the effects of crises, such as the pandemic we are currently in. I am sure, like all joining us today, and in particular, my students in Class C at the Econ faculty at the University of Indonesia, who are all learning these theories currently, really appreciated that, Andrea, so thank you. I'm really excited for the Q&A session at the end of the panel session, where we can delve deeper into your thoughts. So we now turn to Dr. Chatib Basri, Senior Lecturer at the Faculty of Economics and Business, University of Indonesia, former Minister of Finance of the Republic of Indonesia, an esteemed academic who has collaborated with many world-renowned economists at Harvard and MIT, to name a few, on a multitude of topics connected with macroeconomics, trade, monetary and fiscal policies. He is also the best lecturer I ever had, who could explain very complicated trade models to us with such an astounding level of clarity. Pak Dedi, so grateful to have you here with us. Pak Dedi, the floor is yours.
Thank you very much, Nikki, for your very kind introduction. Professor Ferrero, Nikki and I, we are part of the MAS, the Mutual Admiration Society. She scratched my back, then I need to scratch her back. So thank you very much for the introduction. First of all, I would like to congratulate Professor Ferrero. I really enjoy your presentation, and I agree with most part of your presentation. Perhaps that what I will do in the next 20 to 30 minutes maximum is to give perspective from Indonesia and give some comments on your presentation. Yeah, so perhaps let me share my slides here. If you can give a thumbs up if you can see my slides here. Okay, good. So first, I agree with Professor Ferrero that, we have to look at this current crisis from the COVID perspective. Yeah. And I took this chart from the World Bank report, which is very interesting to look at about the issue of the uneven global economic recovery. To me, this is really the big issue now, because exactly like Professor Ferrero said, if the anticipation in the advanced country, with regard to the recovery faster than emerging economies, then will be an implication, to the emerging economies. So if you look at from these charts, we can see that the shape of the economic recovery will depend so much on the ability of country to provide the vaccination. Yeah, and then I can see, I don't know in the case of UK, but I do believe that you are probably quite relatively open. It's no longer on the zero COVID target, but more to minimize the fatality impact rather than focusing on the zero COVID. And then I believe that the economic recovery in the advanced country like UK or US, for example, there is a possibility like a V shape. Yeah, but whereas for the country like emerging economies, we're still struggling with the issue of this vaccination, the recovery will be like in the swash shape, like the Nike logo brand, or even the low income countries is like on the green line here. Yeah, steadily continue to decline. So the vaccine is a very important issue, important aspect when we discuss about the global context, because there will be a ramification to the emerging economies. I did a very simple correlation. Of course, I do understand that this is far from adequate to do so. We need a more robust methodology, but it's very interesting to look at the correlation between total vaccine per 100 people and economic growth projection. So somehow this simple correlation reinforced the argument made by the World Bank. So here is my concern. Yeah, and this has to do with, explanation made by Professor Ferrero. And I would like to pose a question to you, because you've done a lot of work on the monetary policy. In monetary theory or international finance, we learn about the so-called the impossible trinity, the unholy trinity. But based on my experience, Professor Ferrero, I don't think this basic Mundell-Fleming model is entirely relevant with the current situation, at least my experience from the 2008 crisis. Yeah, when the capital inflow, the surge capital inflow coming in to the country, like in the case of 2008, for example, the policymakers left with not much option actually. Yeah, if we let the inflow to coming in, then there is a risk of the inflationary. We are quite lucky at this moment because the demand is relatively weak, exactly what you said. But once the demand back to normal, then we can see the possibility of the inflationary. Yeah, if we let the capital inflow coming in. But the room for the central bank is not much as well. If we try to sterilize the inflow by building reserve, yeah, the cost for us is very expensive because the spread of the Fed fund rate and the Bank Indonesia rate. So this is too costly for the central bank. And if we allow the appreciation of the exchange rate, it's going to kill our export. So I had an experience during the global financial crisis, and when I had to manage the taper tantrum, yeah, basically it's very difficult for the central bank to stick with this to maintain the independent monetary policy unless we start to introduce the capital controls. Yeah, and seems to me that this is a very interesting, yeah, because the role of the macro prudentials become very crucial. When I had to manage the taper tantrum 2013, Professor Ferrero, Indonesia, we adopt the open capital account regime. So it's not possible for us to impose the Tobin tax. So if we try to change the capital account regime, we have to go to the parliament. But this will take 6 months. When we discuss in the parliament, the capital is going to already leave the country, right? So what we did at that time, we introduced what we call the reverse Tobin tax. So rather than penalizing the short-term capital flows, we gave a tax break if companies would like to, move their shift their investment from the portfolio into the longer term. So sort of like to incentivize capital to stay longer. Yeah, we gave a tax break. So that kind of model, that's what I mean by macroprudential. I do understand that one of the options is do the fiscal contraction, but this is politically not easy, especially because there is a risk of the recession. And I would imagine the similar situation probably many of some emerging economies will face soon. Why is that? Exactly what you said. Look at the projection made by the Fed. Yeah, if you look at on the FOMC, based on the December 2020 projection, majority of the FOMC's member believe that they don't need to raise the interest rate. But if you look at on the June 2021 projection, exactly what you said, the probably inflationary in the US will happen faster than expected. So there will be an impact because there is a risk that, the normalization of the monetary policy in the US, the Fed, will happen faster than expected. They're going to do the tapering soon. It reminds me with the situation back on 2013. Yeah, this will have an impact on the emerging economies. Yeah, when this capital, there is a risk of the capital capital outflow, then what many emerging economies are facing is the situation of the strong dollar. Yeah, so and not much, we don't have much option available on this. Exactly the argument that I made, about this, the impossible trinity, the unholy trinity. Maybe my suggestion is what the policymakers can do is a policy mix, sort of like combination of during the taper tantrum, what we did at that time, since we have a cushion, the economic growth in Indonesia was around more than 6%. So we could do stabilization over growth. We could do the expenditure switching and expenditure reducing policy by central bank raise the interest rate. I cut the fuel subsidy, raising the fuel price by 40%, and we let the exchange rate to depreciate. But nowadays the situation is very different, because if the central bank start to raise the interest rate, it's going to hamper the recovery process. If the fiscal authorities start to tighten the fiscal side, then it's going to hamper the the recovery process. So the only option left for the central bank is to let the exchange rate to depreciate, while at the same time they are not going to peg the level but smoothing the volatility. So this is perhaps I would like to hear your view on this, about especially the policymakers from emerging market would like to learn more that the old Mandel-Fleming model perhaps will not work like what we learned when we study. Look at this case. This is very interesting when we learn from the 2013 taper tantrum. Once the Fed introduced the QE, you could see in the green line the forex increase because there's huge capital inflow. Then look at on the current account, because the appreciation of the exchange rate, we start to run a current account deficit. Yeah, the central bank tried to maintain the exchange rate, so as a result, the foreign reserve declined. The situation makes the current account deficits getting worse until we did the expenditure switching and expenditure reducing policy. That's what I mean, there is a limitation of this Mandel-Fleming model. Now let me go to, since I'll be very brief, one thing that I would like to highlight, that's perhaps this will be rather different. I believe that Teguh later on will discuss more about it. In Indonesia, the impact of COVID mostly felt by the vulnerable groups. And the reason behind it is because in Indonesia, only the rich people could afford to be unemployed, because we don't have the unemployment insurance. If you are poor, you have to work. And that's the reason why you can see the unpaid or contributing family worker jump significantly, even though the number of open unemployment increased only, not much actually. Why? Because the rest of them, they went to the informal sector. And this explains why the lockdown or partial lockdown is very difficult to be implemented in the case of Indonesia. Look at this. I tried to conduct a very simple impulse response function to look at about time spent at home and new death cases, because we do have the data. It's a very interesting that every time people hear about the new death cases, the the amount of time to spend at home increase, but only lasts for 3 days. After the day 3, they go outside. So how do we explain this? Because the vulnerable one, they cannot stay more than a week. They have to work. So that is why the role of this fiscal policy, the social assistance, is very important. And look at the savings income ratio. This is very similar for the basic case, the savings to income ratio decline in all the income group except the rich one. Because for the rich, for the upper income, middle income group, they cut the spending on necessity goods and they can save. And that's explained why the capital market soaring, why people, the savings for the rich people increase. So there is a risk of the issue of the K-shaped recovery here. And this is, I think, so looking at this, and again, this is look at the relationship between this mobility and spending. You can see once the economy is reopened, then the spending index increase. And this is the negative relationship with the residentials. So it's very clear. This is crisis by design. Because we ask people to stay at home. So to make people stay at home, we have to pay them. We have to compensate them. And that's the reason why the fiscal policy become very important. Now, I try to look at, the role of monetary policy and the fiscal policy here from the perspective of Indonesia. We are lucky at this moment that the commodity and energy price soaring because the energy crisis in China, some issues related to the coal, the palm oil, etc. But the real challenge is whether the private investment will kick in 2021 or 2022. My take on this, as long as the pandemic is still there, the maximum activities still in place. Why? Because the health protocol is still in place. So it's very difficult to reach the break-even point. So for example, like restaurant, they put the 50%, right? If the 50% number of the customers, then they cannot reach the break-even point. So what's the point for you to expand under this kind of situation? So the private sector perhaps will not kick in soon. Under that kind of situation, what would be the solution? We already discussed about vaccine, or what is the role of the government? Should we support on the supply side, by lowering the interest rate, or we induce the demand side? The idea of this, you lower the interest rate, company will expand, and then they hire people, and the usual multiplier. Or we give money to the vulnerable group, and then they're going to spend money, and there will be a demand. This is, I use this one function as well to look at the relationship between the shock in private consumption and investment. It is very interesting that in the case of Indonesia, if we induce investment, the impact on the consumption is relatively less compared to the other way around. If we induce consumption, the impact on the investment will be relatively high. So in the case of Indonesia, it is very interesting, at least statistically, that investment responds to the consumption. And that's explained why the interest rate in Indonesia is at the lowest point at this moment. But we don't see credit growth. Why? Because what's the point for borrowing money if the demand is not there? So this reminds me back to the traditional concept of Keynesian, about the most important thing on this kind of situation is to induce demand. So that is why, in my view, even though I do agree that there is a room for the monetary policy, but maybe the role of the fiscal stimulus is very important as a jumpstart. And this should be focused on the issue of the extended cash transfer to the vulnerable one, But of course, in the country like Indonesia, the issue is the financing because the tax revenue is relatively low. It's only 8.2%. And by 2023, we would like to have a deficit less than 3%. So under this kind of situation, if we try to consolidate the fiscal soon, there is a risk that we have to cut the spending. And here is my concern. If we draw the fiscal stimulus too early, we are going to repeat the same mistake that was recommended by the IMF in 1998 when we tightened the fiscal during the recession. So in my view, it is very important for the government, for example, to explore, to look at the fiscal policy based on data dependence. Yeah, if the private sector investment is still weak, then probably the room of the fiscal stimulus will continue. Nikki, I do have some slides, but I think I better leave it up here and then we'll give some speakers and then we can have more time for discussion. Thank you very much.
Thank you so much, Dedi. Thank you so much for just a very clear explanation of how the pandemic has impacted the world economy, particularly Indonesia. Thank you also for the very, very concrete illustrations and examples using recent data from Indonesia on the impact of lockdowns, something we are all still trying to understand and probably would need years to understand. And thank you also for outlining possible solutions for governments to undertake. It was just so interesting to see how your work ties together with Andrea's work, and it just illustrates how we really need collaborations across borders in order to come up with concrete solutions for this pandemic. So I'm really excited for the Q&A session. But before that, we now turn to Dr. Teguh Dartanto. Dr. Dartanto is the head of the Poverty and Social Protection and Development Economics Research Cluster at the Faculty of Economics, University of Indonesia. Dr. Dartanto was elected as an Eisenhower Fellow in 2017 and has published extensively on numerous topics in world-renowned journals, particularly on poverty issues in Indonesia, and has done outstanding work also on healthcare policies and health economics, particularly related to Indonesia's universal healthcare system. So Dr. Teguh Dartanto, we're so excited to have you. The floor is yours.
Okay, thank you very much. Good afternoon, everyone. Assalamualaikum warahmatullahi wabarakatuh. Thank you very much for inviting me as panelist in this discussion. And in this discussion, this is the first time for almost after 7 years, I'm becoming a real researcher or real lecturer without any administrative job, as I'm on leave for administrative from administrative job during the process of team selection. And today I would like to talk about the different angle of the COVID-19 crisis, as the Professor Andrea already talked about the monetary policy, and the Prof. Chatib Basri already talked about the macroeconomics perspective about the COVID. Therefore, I would like to complement this discussion with the issues on poverty and welfare inequality, as well as the the future agenda about the social infrastructure investment. I would like to start with the how COVID can influence the poverty and inequality. I think I divide into two things, and the first is how COVID can influence the poverty and inequality. The first is because of the initial condition. Every people, every family, every household has the different initial condition. For example, initial endowment. Maybe the poor doesn't have assets, so they cannot survive during the COVID. There is no opportunity for them, for example, as mentioned by Pak Dedi, about they cannot stay at home for more than a week, example. And also there is no, for example, in social condition, the poor people, they don't cover by social protection. As we know that there is no luxury for the poor or the vulnerable group to stay at home without any job, because in Indonesia we don't have any, we call that unemployment insurance or unemployment benefit. The other thing is about the initial condition, because everyone doesn't have an equal opportunity. For example, access for education, access for everything. And also the issues of digital divide. So because of the different initial condition, and when the COVID come and then the COVID shock, the impact is totally different for every household. And the other thing is, beside the initial condition, the recovery process is also unequal. There is, we call that sectoral bias. Means that the impact of COVID is not equally distributed among sectors. There are some sectors that still enjoy the positive growth, for example, education, health, telecommunication, and also agriculture. But many other sectors is also very affected by the COVID. For example, hotel, restaurant, transportation, manufacturing. So because of the difference growth or the sectoral bias, those who are working in the positive growth sector will be, there is no problem on their welfare. The other thing is like there is a skill bias recovery. In this time of the COVID, those who have like the skilled labor, maybe they can enjoy still working because of the nature of the job can be replaced by work from home. But for unskilled labor and the nature of job is most likely, for example, manufacturing or restaurant, or most of the job cannot done by work from home, but the job can be work from office. So this is the skill bias that maybe influence the future of inequality and also poverty. There is also the size bias, for example, the big company and also small medium enterprises. This is totally different with the crisis in the 1998. At that time, maybe the big company have a many problem with the ASEAN financial crisis, but the small, medium, or micro enterprises will be the engine of the growth at that time. But the current situation, micro, small, and medium enterprise also have mostly affected by the COVID-19. And also there's a regional bias. For those living in, for example, Bali, those area with the dependently or really on tourism, maybe their society welfare is decreased a lot. So if we could look at this condition, maybe we can look at if the initial condition difference, maybe the impact of poverty and inequality will be short-term and also long-term poverty. But the recovery process, or the bias in sectoral bias, regional bias, can influence poverty in the medium term. This is just simple illustration how COVID can influence poverty and inequality. Now, I would like to little bit explain on issue on digital divide. This is just example how digital divide can increase the poverty and inequality during the COVID-19. And this is just the simple illustration. Let's divide the society into the three categories. The first is the low income, middle income, and upper income. And the characteristic is totally different. Low income may be low human capital, lack of access, low skill labor or unskilled labor, and low access to the internet, or maybe not have internet at all. But the upper income, excellent human capital, abundant asset, high skill, and high accessibility to the internet. And look at the nature of the jobs. For the lower income and skilled labor, no opportunity to do work from home. They cannot also utilize the internet or utilize the internet only for leisure. No access of information and opportunity. But the upper income, they utilize the internet for productive activities, high access to information and opportunities. Some of the upper class just switch their during the COVID, just maybe selling the food using the WhatsApp group in this WhatsApp group, or maybe the social media. And most of the upper income, their job can be work from home. Therefore, there is the gap here. The higher income can still have the higher income group, upper income group can have the higher income during the COVID because there is no much change. But the lower income, maybe they reduce or remain constant due to the poor access and also no opportunity for work from home. So this is the poverty and income inequality will increase after the COVID-19. So the issue of digital divide, there is the four important things that we have to solve. The first, access to network. Because like in Indonesia, the network is not equally, the quality of the internet is not equally distributed among region in Indonesia. As we experience that our fellow student from Papua, eastern part of Indonesia, they face difficulty to follow the class because there is no good network. So this is the important thing. So expanding the network is very important. But the second one is, even though we live in the area that have the good access of network of internet, but the problem is access to the devices. If you don't have like the computer, if you don't have any cell phone or maybe smartphone, you cannot use, you cannot do or anything, you cannot access the internet. The third one is, there is no, if you have the good access, you have the devices, and the important thing is the internet package data. So you have a network, you have device, but you don't have any package data, you cannot use the internet. And the last one is knowledge to use the internet for the productive activities. The Indonesian government last year trying to subsidize for internet package, the packet data. But this year is trying to subsidize expanding the access to devices. So this is just simple explanation how the digital divide can expand the poverty and income inequality in the time of the crisis. So this is just the little illustration in Indonesia. This is our paper, our graph that we drew from our paper last year, paper in the Bulletin of Indonesian Economic Studies. Just look at in the right-hand side. The first is the poorest, the 10 is the 10 is the richest. So look at for the primary school. Two out of 10 primary school students from the poorest income group only have access on internet. But the richest, 7 out of 10 having the internet access. What happens if the condition is becoming schooling from home using the internet? So the richest can still enjoy class, can enjoy schooling, they can still learn. But what is the problem of the poor? 8 of them cannot follow the class. So this will create the future learning losses. So this is also the danger of the digital divide, the danger of the current conditions COVID about the schooling from home. So this is also the challenge. Okay, and this is the socioeconomic condition during the COVID, and Pak Dedi already mentioned, but I just rough up that the impact of COVID-19 makes almost 29 million people in Indonesia, 29 million workers in Indonesia affected by COVID-19. 2.6 million unemployed, 24 million reducing work hour, 1.8 million temporary not working, and 0.8 million non-workforce, and means that out of the workforce. The issue is there is like the scaring effect and the habituation effect. Why we call that scaring effect? Those who are unemployed, those who are reducing work hour or temporarily not working, they're trying to get job in, for example, lower wage, for example, or go to the informal sector, or go to the unpaid work. As mentioned by Pak Dedi, that Indonesia doesn't have social protection or unemployment benefit or unemployment insurance. So there is no luxury for low-income people to be unemployed. So there is scaring effect. Those who are unemployed will go to whatever jobs. This is the first one. The second one is habituation effect. So those who are already, for example, unemployed, maybe they discourage them to go to the labor market. Maybe some of them just discouraged or stressful and just out of the workforce. This is also very dangerous. So looking at this condition, the right hand figure shown that, as I mentioned previously, that the current crisis of the COVID-19 crisis is totally different with the ASEAN financial crisis. In ASEAN financial crisis, the poverty increased but inequality decreased. But the recent condition, both are increased. So the inequality, sorry, this is in bahasa, but the red one is poverty, but the orange one is inequality, but the yellow one is unemployment. So there is increasing three of them. So the poverty is increased, inequality increased, and also unemployment. So this is the current situation of Indonesia. And just a little bit, this is not unique for Indonesia, but this is just give you the overview. For in the case of Asia, there is also increase of the poverty. The pandemic has been estimated to increase poverty 88 to 115 million people into the extreme poverty. So this is also the condition, but the poverty, many developing countries will face this current situation. And what happened with this condition? What is the government do responding to this condition? Yes, Indonesia has quite good comprehensive social protection. But we have to say that our social protection is not designed for current situation, for the COVID situation. Our condition, our social protection is designed for example, in the normal situation. And then we have like the good database for the lowest 40% or the bottom of 40. But the problem is the COVID condition on the COVID crisis, the effect is not only impacted the bottom of 40, but many of people around the bottom of 60 also have the bad experience with the COVID condition. So there is the urgent need to expand our social protection. So this is just give you the overview that in Indonesia we still have like the conditional cash transfer, kartu sembako means that food stamp, electricity bill discount, cash transfer, and there is also the village fund for responding to the COVID-19 and also pre-employment card. So this is the condition that last year our government is very struggle how to protect the people, how to protect the vulnerable group, because we don't have any good database over that 40%. So this is the condition that our government already did. Yes, not perfect, but our government do something. This is that we really appreciate it. This is the condition. Okay, maybe I a little bit jump on the issue that the future, the important thing, and this is not only the concern for Indonesia, but this is also the concern of many developing countries in the world. So I would like to say that in this time of the COVID-19, there is some urgent need to invest more on the social infrastructure, because there is a changing, for example, in delivery services. So this is just this is our study with the LPEM, our Institute for Economic and Social Research, in our faculty, and the JICA, Japan International Cooperation Agency, to calculate the social infrastructure needs in Asia in response to the COVID-19. So in we just briefed that the social infrastructure is contained, including the four things: education facility, health facility, public housing, and the government building. So, for example, in education, during the crisis, during the COVID-19 crisis, there is totally changing in how to deliver, how to conduct the schooling. So there is an issue on the learning losses, digitalization in education. health protocol in school. So we have to change our mind how to invest on it. And in the case of the health facility, we have to improve the capacity of healthcare facilities, testing capacities, and also improving the medical supplies and equipment. But interestingly, issues on the social infrastructure, for example, in the public housing is also changing. Because, of course, we have to improve the sanitation and the personal protective equipment. But the important thing is the public housing have to be redefined, because house is becoming have the full role in the time of the COVID. The first, housing as a home, of course. Housing as a hospital means that not hospital in the terminology of hospital, but housings have the role as the medical facilities. For example, stay at home, or for example, we call that isolasi mandiri, it is self-isolation. And also house is becoming the working space, and also the school. So this is, we have to change the definition of the public housing, except for mitigating or to preparing the new normal. And also the government building, there is also changing how we deliver the services. So this is our estimation. This is very preliminary estimation, how Asia and also we split with the lower income, upper income, middle income in Asia, and also by region. Of course, in Asia, we have to invest additional investment on social infrastructure responding to the COVID. Means that 0.4% of GDP to allocate for investing in the social infrastructure to respond in the COVID. In the case of Indonesia have to spend more 0.7% of GDP to respond the COVID. This is the ideal standard, or the minimum standard for responding to COVID. So if you look at this number, maybe not, the message is not the number, the message is we have to spend more, or we have to invest more, or we have to allocate more of the government budget to social infrastructure. So this is also the challenge on the financing. And this is the lastly, my concluding remark. In the time of the COVID, the digital divide contribute to significantly increase on poverty and inequality. We have to protecting job. Protecting job will be in the urgent agenda from the national and the local government, because this is have the many correlations with the poverty, inequality, maybe in the other macroeconomic condition. And then there is an urgent need to develop the first adaptive social protection system, because there is no flexibility in Indonesia. If you are affected by COVID-19 and just register, just declare, like in the developed countries, just declare that we need the social protection or we need assistance. So we have to introduce like the on-demand application system, like in the pre-employment card. People can register by themselves. And the second one, we need to develop the comprehensive social protection, such as unemployment benefit or unemployment insurance. Currently, the government is ongoing discussion on this issue. And lastly, the COVID-19 has increased the urgency of the social infrastructure investment, responding to change in how to deliver social services. So this is at the end of my presentation, and I'm very welcome for question or discussion on this. Thank you very much.
Thank you so much, Pak Teguh, for again a very thorough overview of the current situation in Indonesia, which hopefully pinpoints areas where policy may be most effective, and also for your policy suggestions, which I think are very concrete, and hopefully our friends in the government are listening in today. So just to save time, let us now enter the Q&A session to continue this very insightful dialogue with our panelists. So just a reminder to our audience to post your questions in the chat box. I know we have one question with us, but before we go to this, because Pak Dedi needs to leave us at 4:45 for another meeting, I'd like to first turn to Andrea. And coming back to Pak Dedi's questions, if I have summarized this correctly, how do you think the analysis you conducted in the space of the developed world may apply to emerging economies such as Indonesia? And Pak Dedi, please add to this if I have missed anything. Please go ahead, Andrea.
Yeah, I think Dr. Basri highlighted a dimension of the discussion which was missing from my presentation, which had to do with the international dimension of this crisis. And I think it goes also beyond even before the crisis. This was a topic that had attracted a lot of attention. Ellen Ray brought up this issue in her Jackson Hole presentation in 2013, highlighting the limitations of the traditional Mendelian view of capital flows. And I think Dr. Basri probably also from his past self of a policymaker had direct experience in this regards. And I think he made many important points. And I think I largely agree with all of his points. There's a textbook model that says that flexible exchange rates are great and sort of tend to insulate countries from external shocks. And then there is practice and evidence that says, well, that's not quite true. I think that my understanding of the literature and the more recent evidence is that there is an important interaction between the global financial system and the way it has developed. You know, we should remember that Mandel wrote his papers in the 60s when the global financial system was much less developed, there was much less interconnection. And I think he was thinking mostly in terms of trade, right? So you have an external shock, a depreciation of the exchange rate is great because it boosts your domestic trade, and vice versa, and that works as the adjustment mechanism. Nowadays, probably that channel is much less important, or in other words, the financial adjustment of capital flows, overheating, when we think about inflows and the negative consequences instead of outflows, I think are probably dominant. You know, there were several references in the previous two presentations to the late 1990s crisis that also in Indonesia unfortunately had to suffer. And I think that the consensus nowadays has shifted a little bit. I mean, my impression is that if you talk to the IMF, they still probably think that flexible exchange rates are good. But I think they acknowledge much more that they're not a panacea. I mean, they're not the solution to every problems. And I think Dr. Basri alluded to a very important point, which is the possibility of using additional instruments. I mean, it's relatively obvious that the more instruments you have, the better situation you are in, right? Because you can target different instruments to different purposes. And then ultimately, the government has certain objectives, and we should just think about how you deploy your instruments to achieve those objectives. And I think the use of what he called macroprudential policies is my impression from a general macroeconomic policy stabilization perspective is the right thing to do. You have these additional instruments, and the case of Indonesia was mentioned, incentives for foreign investments to control in some sense fluctuation in capital flows. It sounds like a very reasonable policy to implement, and so I think that my impression is that there is agreement. I know that the IMF has developed this new it's called, I think, integrated policy framework, where they think about multiple instruments in a world that is interrelated, not just in terms of trade, but most importantly on the financial side. Can I quickly react to another theme, I think, that came out from both presentations, which I think is also very important and possibly the most important from the pandemic. I mean, I talked about monetary policy, but I'm the first to say that, in this crisis in particular, the most positive development, I think, was a much more active use of fiscal policy. And I think it was much needed, and I absolutely agree with what all was said, especially, I mean, one lesson that I think we took from the financial crisis and then continue for the next decade is that we should pay a lot more attention to inequality. I think that's really important, and monetary policy can do a little bit, but I mean, it's not the right tool, and fiscal policy is. And the development of a social security net, that I think was the underlying theme of Professor Dartanto's talk, and the specific intervention that Dr. Basri talked about, are necessary. There is obviously a concern in some circles, at least, about the impact on debt through deficits and so on. But if I can refer back to my presentation, we're also living in a world of low interest rates. And I think that it's a good opportunity, especially in times of crisis, for governments to intervene and, support the economy that is facing, such a disastrous consequences from the pandemic. And then, think about that sustainability in the medium run. I don't want to say that we should ignore that sustainability, as would be the wrong approach, and could plant the seed for future crises. But at the same time, I don't think we want to go back to the fiscal austerity policy that sort of came out of the 2010 European debt crisis.
Thank you so much, Andrea. So, Pak Dedi, please, could you respond to Andrea's answers?
Well, I think I don't have much things to comment, because I completely agree with Professor Ferrero. I agree that probably the literature since 2013, after Helena Ray mentioned about this, the limitation of this Mundell-Fleming, somehow economic policy, especially unrelated to the issue of this international finance, is more open now. At least my understanding is, before 2008, capital control was sort of like a taboo, but now even the fund is relatively open, even though they use a better word for that, is macroprudential, some selective intervention. And I do believe that somehow it is needed. Perhaps several policies can be done related to that. But the issue is, the idea is managing the capital flows. And I would imagine a country like India, like Indonesia, with probably after the quantitative easing, after the QE, receive huge capital inflow, will be at risk when the Fed decided to unwind the monetary policy in the US. So somehow that kind of policy is needed. That's the first one. The second one, I think I completely agree with Professor Ferrero as well, about the role of the fiscal policy. Perhaps even since the 2008, the global financial crisis, 2008, the room for the monetary policy, even though is there, but relatively limited. We could see that similar situation, interest rate during the global financial crisis was almost zero as well, but we don't really see the impact on the economic growth Professor Summers call it the secular stagnation in this kind of situation. So that is why there is a need of the fiscal stimulus. But Professor Ferrero, one thing that become an issue for many European countries, your fiscal space is also limited, right? So even though we need zero lower bound of this interest rate policy, limited room for the monetary policy, but not all of the country have luxuries for the fiscal space as well, right? So somehow this is an issue that need to be solved. That is why the idea of the structural reform is very important. But if you're talking about the structural reform, you touch the very sensitive issue about the political economy. And let me quote what Jean-Claude Juncker said: "We all know what to do. We just don't know how to get re-elected after we've done it." And that's the biggest problem in policy. So, but I agree with Professor Ferrero that one thing that's also important with the relative low interest rate is the chance or opportunities for the green recovery. Yeah, because once the interest rate is relatively low, I think there is a room for the expansive investment, yeah, related to the climate change, to the green recovery that can be done. Yeah, and there is a room for that. Yeah, that's the first one. And also, this is exactly what Professor Dartanto said regarding the digital divide, because the investment in digital is also very expensive. But if we are in the relatively low interest rate zone, there is a room for that. So I think that's my response, Nikki. Thank you.
Thank you so much, Pak Dedi. That was just amazing. And Pak Teguh, so before we go to the question in the chat box, Pak Teguh, do you have anything to add?
Another round of the question, Nikki.
Okay, Pak Teguh, thank you so much. That was just such an amazing dialogue between you all. It's just the reason why we do these webinars. So we have one really interesting question from Bapak Hairul Mubin, and he is, I think, from the postgraduate program of economics at the Department of Economics. So he's asking, with all these tools, and one of the tools is liquidity injections. And so what are the possible side effects of liquidity injections, and could it possibly cause an asset price bubble, and how can we stop that from happening? So probably I'll go to Pak Dedi first, and then Andrea, and then Pak Teguh for comments. Pak Dedi, please go ahead, and thank you.
Well, I'm not an expert on the specifically on the monetary policy, but let me try to respond this question. Yeah, I think Professor Ferrero in his presentation gave a very insightful, is a very clear explanation about the mechanism of the quantitative easing, the liquidity injection. One thing is very different with the so-called the conventional monetary policy is the way they affect the long-term interest rate, for example, and they are doing it through the the balance sheet rather than giving the money directly. But if I may respond to it, yeah, I don't see any risk related to the issue of the inflation at this moment, as long as the demand is relatively weak. Yeah, but my concern is when people have money but they don't know to spend. Yeah, and this is exactly what is happening in many countries, including in Indonesia. They're going to put this money into the stock market or bond market, and that's where the risk of the risky asset, the risk of the asset bubbles come. Yeah, we can see the recovery in the portfolio in the stock market in Indonesia is like a V shape. Yeah, whereas you can see the recovery in the economy is like a swash shape. So there is a sort of like decoupling between this financial sector and real sector. Yeah, because the liquidity injection, in the case of Indonesia, well, in the case of Indonesia, because they cut the necessity spending, so they have savings and they don't know where to go. But I can imagine a country like US, for example, because the restriction, the mobility restriction, the injection of the liquidity from the FEB, this somehow will have an impact on the asset price. Yeah, so the concern is always about the correction on this asset price. But I don't know, probably if Professor Ferrero can comment on this. Seems to me that market has been very patient, yeah, so far, because we haven't really seen a sort of like a correction, even to some emerging market. Yeah, their fiscal deficit increase. Country like Turkey, even country like Turkey, market has been very patient. You know, they don't react negatively to some policies. So perhaps Professor Ferrero, if you can say something related to that, whether this, to me, this will not be sustainable. But how come the market become so patient at this moment? Is it because they don't have choice at this moment, or maybe if you have any other reason for that? Thank you.
Thank you, Panellist. So Andrea, over to you, please go
ahead. Yeah, well, you know that there is this famous saying that, I mean, I guess goes in many ways, but basically the essence is, you know, if I knew what a bubble was, I would be rich. I guess what I want to say is probably we want to be careful in a sense and distinguish why we should be concerned about a bubble, assuming that the one is ongoing. Whether it's are we concerned about a correction, or are we concerned about more broadly about financial stability? Let me just give you an example. Go back to the late 90s and, you know, the first internet revolution, the dot-com bubble, right? So that was a big stock market bubble. Valuation went up and down. Some people got burned. Some people became extremely rich. So there were big distributional effects among participants. But the consequences for financial stability were limited, if any, right? Now we go to the housing bubble and we know the catastrophe that followed. And so the second one really had financial stability consequences, the first not. Now go to the post-financial crisis period, you know, QE and liquidity injections took place back then. Many people were concerned about another bubble. Valuations went up. There was some correction, not maybe really a crash, but there were no financial stability consequences. So I think, and then we can make we can look at many other examples. I think the bottom line is the one thing that we know is that leverage bubbles are really problematic. And so when we're thinking about whether there's a bubble, I think we should ask also, you know, how much leverage is going on, right? So that's concern number one. And the second question, which I referred to, is what are the financial stability consequences of these asset price movements? I mean, my impression, and I may be wrong, is that at the moment, possibly because, you know, the lesson of the financial crisis is still fairly fresh in our mind, there is quite a bit of oversight such that hopefully there won't be a big impact also from a large correction in terms of financial stability. Again, I don't want to say that there won't be people who are going to lose from that. Again, there will be people who are going to gain from that. But I don't think at this point it would justify doing anything too aggressive to the extent, again, and this is the really crucial caveat in my mind, that, you know, we're taking properly into account the consequences for financial stability. So that is sort of the approach that I hope policymakers around the world are following. My understanding from people I've talked to at central banks and in other institutions is that this view is broadly share. I don't think it's universal. I think there are people who are a lot more concerned and they would like monetary policy actually to be more aggressive and actually to use the interest rate actively to prick these bubbles. I think would be a little bit too blunt of a tool to do so. And so, I think we have other instruments that go again under the umbrella of this macroprudential set of tools that can be used in this case domestically, not necessarily on the international side, to take care of this mechanism. The last point that I'm going to make very quickly is that I totally agree. There seems to be this very high appetite for investment in financial instruments. There seems to be much less appetite for investment into productive assets. And even when we think about the structural transformation, especially that a number of economies undergoing, all the new economy, everything that is related to internet technology, apps, etc., really relies on relatively little physical capital and a lot more on financial capital. And so maybe that's also what's driving demand for this type of investments, which is less productive in a traditional sense, and contributes instead to stimulate financial instruments.
Thank you so much, Andrea, for that really clear overview. You've managed to cover so many things in such little time. We have a really interesting question for Pak Teguh in the chat box, but I'm conscious of time. So before we go to that, so Pak Dedi, I know you have to leave in another couple of minutes. So Pak Dedi, you have such extensive experience with economic policies used to stabilize markets in the midst of crises. You carried us through a really strong recovery after intense economic shocks during the time you were finance minister. So do you have any sort of final words on messages to governments and to everyone on how best we can weather and face this crisis?
Well, thank you, Nikki. I think one thing that I learned from this pandemic, I believe that policymakers humbled by the reality, because there are so many things that we don't know at this moment. Yeah, I always make a joke if my colleague make a projection about economic growth with 2 digits behind below the point. It just shows that they have a sense of humor, because no one can predict this the economic growth at this moment, because we never know about the pandemic. But we learn a lot of things on this process and situation. And also from the macroeconomics perspective, especially in the international finance. After all, we are all Keynesian at this moment, because the theme of the fiscal policy all over the world is do whatever it takes. But at the same time, the biggest question for all policymakers, for all of us, is how to unwind all this stimulus. Yeah, the exit strategy will be a very big issue. The second one is the risk of the debt distress, because there is a risk of it. Asset bubble price and the emerging market have to reconcile between the spending, increase the budget deficit to finance all the policy that proposed by Pak Teguh, for example, on the one hand, but on the other hand, there is a risk for them to lose their opportunity to get the financing in the future as well. Yeah. In addition to that, the issue of the climate change has come into the picture. This is also something very new. So in short, I have to say, Nikki, I think we have to learn a lot of things, and we are humbled by the reality, many things that we don't know. Yeah, with that note, so thank you very much for having me. Professor Ferrero, nice meeting you. Pak Teguh, I'm sorry that I have to leave because I have another commitment. So thank you very much.
Nice
Thank you so
meeting you.
much, Pak Dedi. I think everyone joined together to thank Pak Dedi for his really amazing insights. So Pak Dedi, hope your next commitment goes well, and we hope to see you soon for future webinars. Thank you so much.
Thank you.
Thank you, Pak Dedi.
Yeah, thank you very much.
Okay, well, so going back to the question in the chat box to Pak Teguh. So we have a question from Pak Aan Zurianto. Pak Teguh, why does Indonesia need more financing to handle the impact of COVID-19 more than other countries?
Okay.
Please go ahead, Pak Teguh.
Yeah, thank you very much for Nikki and also Aan. Why Indonesia needs more financing for social infrastructure needs? Actually, before the crisis, before the COVID-19, to meet the minimum standard, Indonesia needs 5.7% of GDP to invest in social infrastructure. But because of the COVID-19, we need more. Why we need more? Why is 0.7%? The first is Indonesia does not invest adequately before the COVID-19. So Indonesia does not, the investment is not, Indonesia does not invest enough before the COVID-19 to reach the minimum standard of the service delivery in the social infrastructure, health, education, public housing, and the government. Therefore, during the crisis, there is the additional minimum of standard increase. For example, in health services, before the COVID-19, maybe one hospital bed per 1,000 people is enough. But during the COVID-19, maybe we need to increase, for example, two hospital bed per 1,000 population because the needs of the COVID. So that Indonesia have to invest additionally, and there is additional investment 0.7%. I think it's not only Indonesia, but for example, India also need to invest additional investment 1.6% of the GDP. And the previous one, before the COVID, India, we estimate that India only need 4.9% of GDP without the COVID, but with the COVID, India need to invest more, around 1.6% of GDP because of the increasing demand or increasing the standard of social service delivery of the education, health, public housing, and the government building. This is the two reasons why Indonesia need more additional percent of GDP to invest in social infrastructure compared to the Asia average is only 0.4% of the GDP.
Thank you so much, Pak Teguh. Just a little bit of maybe a follow-up question, or probably not a follow-up question to that, is you mentioned in your presentation the challenges of data collection in the midst of COVID-19 and the challenges of implementing conditional cash transfers based on data collection, and also the increasing reality of more and more people going into poverty. So looking at the bottom 40% wouldn't be enough. We need to increase that number. So do you think other sort of policies such as implementing an unconditional cash transfer or implementing universal basic income policies would be something of an option for Indonesia? So please, Pak Teguh.
This is always challenging question from many people. Why don't Indonesia implementing, for example, the universal basic income, isn't it? That just distributing money for all. This is theoretically is good, but practically is very, very difficult because there are many reasons. For example, fairness, for example, why the rich also getting the transfer also. And actually, this is the first one that the philosophically may be unfair. And the second one is the issue is the government does not enough resources to do that. Because under current condition, our government, our deficit is also almost the 6%. That's allowed by the regulation. But after 2002 or 2023, the government have to back to the 3% of the budget deficit. So the universal basic income for Indonesia, I think, is not a good option. So my suggestion is how to make the social protection system is more adaptive or more agile. So this is, we should have developed this adaptive social protection. One of the solution is allowing the people to do like the self-registration on demand application. So they just declare that I need the social protection, and then they can register with the sum of the information, and then just the government give, for example, 1 month or 3 months, and then after that we evaluate. If not eligible, and they just kick them out. So this is also a very simple thing. Maybe there is many issues about, for example, people are afraid that if we open it and then many Indonesians will register, blah, 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 blah. So, but I think we can follow the idea of the pre-employment card. There is also screening, isn't it? So pre-employment card is one of the type of the on-demand application of the social protection system, actually. So maybe we can adopt this kind of system into, for example, unconditional cash transfer or food stamp, for example. Maybe using the on-demand application is one of the solution in the current situation, instead of proposing the universal basic income.
Thank you so much, Pak Teguh. And it's just really amazing to listen to just the immense experience that you have with social welfare policies. We have another really exciting question for Andrea here in the chat box. So it's on average inflation targeting. Would average inflation targeting create a taper tantrum, particularly in emerging markets? So I think, and if it does create such a phenomena, how do you reduce the impact of average inflation targeting that the Fed is doing on emerging markets such as Indonesia? So I hope I explained that clearly. So Andrea, please go ahead.
Yeah, so basically, average inflation, just to clarify, average inflation targeting, the key difference with traditional inflation targeting is that with inflation targeting, you have a negative shock, let's say a negative demand shock that pushes inflation below target. And what the central bank tries to do is to implement monetary policy as to bring inflation back to target. But basically what happened in the past, meaning the effects of the shock, are forgotten. There's this way of characterizing inflation target that says under inflation targeting, bygones are bygones. With average inflation targeting, depending on how the central banks decides to construct the window over which it averages, right? You take into account also what happened in the past. So when you have a negative shock like the financial crisis or like COVID and inflation falls below target, let's say for a year, then what you would expect is the central bank to let inflation run above target for the following year, so that on average over 2 years, inflation is on target, right? So in principle, you're going to have a little bit more of volatility of inflation, because you're not going to go back immediately to target and stay there, but you're going to overshoot a little bit. So in the current situation, what does that mean? Well, it means that the Fed will tolerate some inflation above 2% for some time in the future. Will it generate a second taper tantrum? Well, actually, it should not, I think, because the Fed should tolerate more more inflation and hence have more expansionary policy or accommodative policy for a longer period. And so it shouldn't respond to inflationary pressures, for instance, those that we're witnessing right now, too aggressively, or at least as aggressively as it would have under a standard inflation targeting. So in that respect, I don't think that's the case. On the other hand, what could be worrying in terms of effects on foreign economies is a persistent supply shock such that inflation does run above target for a prolonged period. So if this supply chain kind of disruption that we're experiencing today are going to last for a very long time, then, you know, the average inflation will be above 2%, and then we should expect a period of below target inflation, so that again, on average, inflation is at 2%. So there is this kind of moving window, and that's sort of what we need to understand. I think perhaps one dimension that has not been terribly clear in the Fed communication when they announced the average inflation target is actually the window over which the Fed is looking to keep inflation at 2%, because that's going to make a difference, right? So if I want inflation on average to be 2% over 1 year rather than 2 years, that's going to make a difference in terms of the kind of expectation that I should form. At the same, the last thing I'm going to say, though, which is a sort of a mitigating factor in this, is that it should also make Fed's policy a little bit more predictable. And so for also, it should give a little bit more time to other economies to adjust their policies if there is this high degree of interdependence.
Thank you again, Andrea. You always manage to cram in just a lot of information in such a short amount of time. And now, conscious of time, I know it would be great to be able to continue this discussion for hours, because at least I have so many questions in my head that I would like to ask our panelists. But with that note, we unfortunately have to come to an end of our webinar. So thank you so much to our eminent speakers, so Professor Andrea Ferrero, Pak Dedi Basri, Pak Teguh, and Professor Priadi for opening today's session. We also thank the nearly 200, so we had, at one point we had nearly 170 attendees who joined us today from all around Indonesia, from all around the world. Thank you so much for your very important questions and your kind attention. I think it's really remarkable that despite the pandemic, we can all still gather together to talk about solutions to the challenges we are all facing today. With a little help from technology, even though we can't meet in person, the strength of collaboration and knowledge sharing seems to transcend all boundaries and all borders. And it's this strength, or as we say in Indonesia, semangat untuk gotong royong, or working together, that brings us hope. If we work together to find solutions for an equitable recovery, no one will be left behind as we embark on this journey to facing the challenges brought to us by COVID-19. We hope that this webinar is the start of many discussions to come on discovering solutions to the challenges we are all facing today. And please look out for more webinar links on such topics, and stay well and safe, everyone, and to all our panelists. And we welcome you to our next webinars and next sessions. So thank you so much, everyone.
Thank you, Putu.
Thank you
very much for organizing.
Thank you so much, everyone.
Thank you, Ferrero. Thank you.
Bye.
Thank you, Pak
Bye.
Teguh.
Thank you, Andrea. Thank you, Nikki. Thank you, Pak Teguh.
Thank you,
everyone.
everyone.
Bye.
Professor, thank you.